In this recording, we're going to discuss the topics in Chapter 13. We're going to start with the at-risk rules. An at-risk activity includes any activity that is engaged in for a trade or business or the production of income. The initial amount at risk is any contribution by a taxpayer of money and/or the adjusted basis of contributed property. Cash and property contributions, shares of liability, and income and gain items are going to increase a taxpayer's at-risk amount, and property and cash distributions from a business, along with a release of liabilities, would decrease a taxpayer's at-risk amount. Form 6198 is going to be filed with a taxpayer's tax return for each activity that is subject to the at-risk limitations. The liabilities can affect at-risk amounts if there is any recourse, non-recourse, or qualified non-recourse debt involved in that activity. Losses are going to be disallowed over the at-risk amounts. Those losses are going to be carried over indefinitely, and then they will be deductible in years when the at-risk amount increases. Losses may still be subject to the passive loss limitations. When they're carried over, they'll just be continued to be carried over. So next, we're going to talk about passive activities. So what is a passive activity? It is an activity that a taxpayer does not materially participate in on a regular, continuous, or substantial basis. Most rental activities and limited partnership interests are considered to be passive activities. There are 7 tests for material participation in passive activities to know whether the taxpayer is actively or passively participating in that activity. So the 7 tests are that the taxpayer participates for more than 500 hours, has all of the participation in the activity, participates for more than 100 hours and not less than any other person, or participates for more than 100 hours and several activities that in combination exceed 500 hours, or is a material participant for any of the last 5 out of the 10 years, or is a material participant for any of the last 3 for personal service activities. The personal service activities would be an accountant or a lawyer, a doctor, dentist, that type of thing, where there's personal service involved in that activity. So in order to be considered an active participant, the taxpayer must meet at least one of these 7 tests. The general rule for passive losses are that they are allowed only to the extent of passive income. So passive losses cannot exceed passive income. Income and loss items are going to be separated into 3 categories on a taxpayer's tax return: active income or loss, so this would be W-2 income or income from a business on Schedule C, portfolio income, which is investment income, or passive income or passive losses. Passive losses are not allowed to be offset against either portfolio or active income. Real estate activities are usually passive activities. However, there is an exception for real estate professionals who are engaged in this activity as their regular job and are actively participating in that activity. There are 6 other circumstances where rentals are not passive. If the rental period is less than 7 days, it's considered to be an active activity. If it's 30 days or less and significant personal services are included, if there is extraordinary personal services included in the rental, it is incidental to a non-rental activity, and the rental is customarily available during defined business hours, or it is rented to an entity that the taxpayer owns. There is a $25,000 loss allowed for rental activities if there is active participation and the individual owns at least 10% of the property. This starts to phase out when AGI reaches $100,000, not including the rental loss, and is limited when AGI exceeds $150,000. If a passive activity is disposed of in a taxable transaction, then passive losses are going to be allowed against non-passive income. Suspended passive losses are going to be permitted, and gift and inheritances do not trigger the use of suspended losses because it does not meet the definition of a taxable transaction. So let's look at an example. Sylvester is an accountant and he owns a mail order business in which he participates. He has one employee who works part-time in the business. Which of the following statements is incorrect? So A, if Sylvester participates for 120 hours and the employee participates for 120 hours during the year, Sylvester does not qualify as a material participant. Well, that would be true because he has an employee that is participating in the activity more than he is. B, if Sylvester participates for 600 hours and the employee participates for 1,000 hours during the year, Sylvester qualifies as a material participant. That is true because he is participating in the activity for more than 500 hours. If Sylvester participates in the activity for 495 hours and the employee participates for 520 hours during the year, Sylvester qualifies as a material participant. Now that is not true since the employee, again, same situation as A, is participating for more than him and he has not participated for more than 500 hours. If Sylvester participates for 105 hours and the employee participates for 5 hours during the year, Sylvester probably qualifies as a material participant. This one would be true since Sylvester has participated for more than the employee. It would probably qualify him as a material participant in that activity. So next we're going to discuss how at-risk rules and passive activity loss rules are used in conjunction. So we need to apply the at-risk rules first and then passive loss rules second. So taxpayers would need to file Form 6198 for each at-risk activity and then Form 8582, one for all passive activities. The passive activity rules do not come into play unless the loss is first allowed under the at-risk rules. So the loss would first have to pass and be allowed under the at-risk rules before we would apply any of the passive activity loss rules to that activity. So let's take a look at an example of using these together. Sydney is a successful doctor. This year he has $200,000 in income from his practice, which is salary income, and he also earns $50,000 in income from investments, which is investment income or portfolio income. Sydney invests $25,000 in a real estate limited tax partnership tax shelter. The partnership owns several rental properties that operate at a substantial loss. At the end of the year, the partnership informed Sydney that his share of the partnership's annual operating loss is $75,000. How much of his share of the partnership's operating loss can he deduct against his active or portfolio income? So, because passive losses, which that $75,000 operating loss is a passive loss, are only deductible from passive income, Sydney cannot deduct any of that $75,000 loss from his medical practice income or his investment income. He earned no passive income during the year. He only had that big loss. So he cannot use his passive loss at all this year. So his real estate tax shelter turned out to be useless. So this is one of the reasons that the IRS code does include these the at-risk and passive loss rules in conjunction, so taxpayers can't end up investing in tax shelters and having large deductions of passive losses deducted from their regular salaries or investment income. So what will happen with Sydney is that his $75,000 loss, his passive loss, is going to be carried over to the next tax year, um, going forward, as long as it takes until he has some passive income to offset that loss.